I have an investment opportunity that can generate a potential return of 35 to 40% in less than a year. Pay close attention to this story because the devil is in the details. The reason for this massive discount has nothing to do with the actual business itself, but rather the likelihood of a buyout going through. And the crazy part, the buyout not going through might be the better opportunity. Let's dive right in. Okay, 3 pieces to this video. Number 1, the business model. What does the company do? The company in question is an operator of grocery stores. Number 2, the opportunity. Positives and negatives. I will give you all the details of the buyout in question and the potential investment opportunity. And then number 3, valuation. On Wall Street, we build 3-statement financial models culminating in a DCF or discounted cash flow valuation. I have built a 3-statement model with a DCF valuation, and I can't wait to give you all the details. So let's dive right in. Okay, so part 1, the business model. I know what you're thinking. Come on, Ken. Grocery stores? Really? What happened to all the sexy tech stocks? While grocery stores are not nearly as interesting as AI, I'm looking for great investment opportunities. I don't care about the industry, the sector, but the return potential. The company I will be discussing is Albertsons. Albertsons operates 2,269 grocery stores across 34 states under 20 different banners. So if you haven't heard of Albertsons, maybe you've heard of Safeway, Tom Thumb, King's, or Acme, just to name a few. The company has a number 1 or 2 position by market share in 70% of the 121 metro areas in which they operate. In addition to grocery stores, they also operate 1,725 pharmacies, 1,336 coffee shops, and 402 fuel centers. They serve 35.3 million customers per week on average. They have 285,000 employees, 62% are part-time, but some interesting information here. In terms of employees that have 15 years or more experience, they have 61,000. That's more than 21% of the total workforce. And in terms of employees with over 20 years experience, that's 44,000 or 15% of their workforce. So almost 37% or 105,000 employees have 15 years or greater experience with the company, which means people enjoy working here and they have loyalty. More good news. AI is not going to put grocery stores out of business. And in fact, online shopping and delivery has actually helped the business out tremendously. So what's the opportunity? Way back in 2006, private equity firm Cerberus took Albertsons private in a leveraged buyout where an investment firm uses debt to buy out the shares of a company. While leveraged buyouts tend to last 5 to 7 years, the global financial crisis caused a change in plans, and it was not until 2015 when Cerberus considered an IPO of the company so that they could cash out their investment. Finally, in mid-2020, Cerberus was able to complete a downsized IPO of Albertsons, valuing the company at $9.3 billion or $16 per share. That was below the $18 to $20 target, and Cerberus owned about 32% post-IPO. Today, Cerberus owns 26% of the outstanding shares of the company. Now, on October 13th, 2022, grocery store competitor Kroger, the largest grocery store chain in the country, entered into a merger agreement with Albertsons to combine the two businesses. The offer was for $34.10, which represented a 32.8% premium and would be broken into 2 pieces, $27.25 cash and a special dividend of $6.85. The special dividend totaling $4 billion was paid in November of 2022, leaving the remaining $27.25 to be received by Albertsons shareholders. Now, the combination of the number 1 and number 2 grocery stores obviously is going to present concentration issues. So the companies planned on divesting stores because they knew there would be competition issues in certain markets. So to satisfy regulators, the company planned on selling 413 stores to C&S Wholesale Grocers for $1.9 billion. But after the Federal Trade Commission, or FTC, sued to block the deal in February of 2024, the company added 166 stores to the divestiture, increasing it to 579 stores for $2.9 billion in April of 2024. While they're still awaiting FTC approval, Albertsons stock has floundered and recently has gone down below $20. This is a sign that the deal is not likely to go through. So buying the stock of a target company after a buyout deal has been announced is known as merger arbitrage. You basically buy it at a lower price than what the actual deal price is, and you make the spread in between. Now, it's always going to be predicated on the deal receiving regulatory approval. Now, a famous recent example of merger arbitrage involved Microsoft's $69 billion purchase of Activision Blizzard for $95 per share in late 2022. The stock traded down to the low 70s, and Warren Buffett built up a 9.5% stake. After 633 days, the deal finally closed in October of 2023, providing a really nice payday for Buffett. If you're enjoying this, please smash that like button. Now, never forget the words of our old pal Warren Buffett: price is what you pay, value is what you get. So since the announcement of the Kroger deal, Albertsons has continued to grow, and it's kept costs in check despite rising inflation. Yet, the stock has gone sideways. The stock is trading based on the likelihood of the deal going through at $27.25. And if you buy it at $20 and it does go through, you get a nice 36% return. But if the deal does not go through, that might even present a more lucrative opportunity because the stock has grown in value in the last 20 months since the deal announcement in October of 2022. You are not going to see eye-popping, massive growth from a business like this. It's a grocery store. But here's the good news: steady equals predictable. All right, the moment we've all been waiting for, the valuation. So we're going to start out, as we always do, with the balance sheet. Now, this is not like the tech companies we've seen in past videos. Inventories have been stable through COVID at a 5-year compound annual growth rate of only 2.7%. Now, while this business is very working capital intensive, we're talking about accounts receivable, inventory, and accounts payable, it is not capital intensive. So it's not a very CapEx heavy business. Over the last 5 years, the company has had a net pay down of $2.5 billion of debt. Now, while cash is only about $200 million, it's projected to 10x over the next 2 years based on our model. The company had almost $3 billion of cash at the end of 2021, but paid a $4 billion special dividend as part of the Kroger merger in 4Q22. Now, in February of 2023, the company closed on a revolving credit facility with a limit of up to $4 billion. So what is that? Think of like a credit card for a company. They ended up drawing $1 billion to help pay the special dividend, in addition to the nearly $3 billion of cash. And we're going to see this when we get to the cash flow statement. So what's the takeaway? While the company has over $8 billion in debt, the business is very stable, steady, and able to handle the leverage. Let's hop in the model. Okay, so as I mentioned, the company had almost $3 billion of cash at the end of 2021. The bulk of that was used to pay the special dividend, not a big growth in inventories. You see, it's very steady and slow, not a very capital intensive business, so you don't see PP&E ramping up either. Now, debt obviously is over $8 billion. This is coming out of that LBO that we talked about earlier with Cerberus. But at the end of the day, they're paying down a lot of the debt and they can handle the leverage. All right, next we have the income statement. So top line revenue growth has achieved a 5.5% rate over the last 5 years, while net income has increased more than 10x that rate over the same 5-year period to the tune of 58.1%. Now, this is indicative of a very efficiently run business with massive operating leverage. Remember, revenue is what you make, net income is what you keep. Now, margins have expanded across the board, which means that as revenues have grown, costs have grown at a slower and lower rate. So they're keeping more money in their pocket. And despite rising interest rates, the company has done a great job keeping interest expense under control by locking in low fixed rates in and around COVID when rates went basically to zero. So what's the takeaway? Growing revenues, cost control despite inflation seen in expanding margins, positive operating leverage give us a very well-run company despite a tough business environment. Let's hop in the model. All right, so as we mentioned, the revenue growth is 5.5% over the last 5 years. They have almost $80 billion of revenues. Really incredible. Now, if you look at the interest expense, despite having $8 billion of debt and a rising interest rate environment, they really kept a lid on that interest expense getting out of control. And then lastly, net income has increased 58.1% over the last 5 years. So we're talking about CAGR, compound annual growth rate. So that's the annualized growth rate over that 5-year time frame. So revenues 5.5%, net income 58.1%. That's a 10x difference. That's absolutely incredible and very, very rarely seen. Okay, next we have the cash flow statement. Free cash flow has almost doubled in the last 5 years, and operating cash flow has increased almost 60% over the same 5-year period. Now, this is not a high cash flow business, but rather a growing and steady cash flow business without much volatility. Now, the company has generated $3.2 billion of free cash flow over the last 3 years combined. You're going to see that $4 billion special dividend the company paid at the end of 2022, and the company has been paying dividends on the common stock since its IPO in 2020. So what's the takeaway? Positive trajectory with large potential upside. Let's hop in the model. All right, so as we mentioned here, nice growth in free cash flow over the last 5 years, as well as operating cash flow. You see the special dividend payment of almost $4 billion at the end of 2022, and the company has been paying dividends over the last 4 years to shareholders since the IPO. Forecast drivers and DCF assumptions. I'm using a very conservative 1.5% top line revenue growth rate. EBITDA margin works out to be only 5% in the projected years, which is below the 3-year average of 5.2%. Again, conservative. Company has a very low beta of 0.5 because it's not in a volatile business, unlike our recent tech analyses. The company does have significant leverage. 41% of its total capital is debt, but it is very manageable. It also reduces the discount rate, the weighted average cost of capital, which is going to increase valuation. We're going to see this next in the DCF valuation. So what's the takeaway? Conservative assumptions are going to give us conservative results. Let's hop in the model. All right, so as I mentioned, top line revenue growth going forward, 1.5%. We're going to see right here, the cost structure is 95%, so we're going to see a 5% EBITDA margin. Moving down to the DCF assumptions. So if we look at the DCF assumptions here, we have a risk-free rate, 4.23. That's a 5-year rate because we have a 5-year model. Beta, again, 0.5, pretty low. It's not a very volatile company. Market risk premium, 4.12. So we get a cost of equity pretty low, 6.3% approximately. Now, something to be aware of, the company's debt rating is BB+. This is called sub-investment grade. So it's not that good. It's indicative of the fact that the company has a lot of leverage. But despite that, they still have their interest expense under control. They get a post-tax cost of debt, 4.71. A weighted average cost of capital of 5.64, which is actually very, very, very conservative and reasonable. If we look at the total capital, $19.6 billion. We have 41% of that obviously is debt. And then something I want to put a pin in and double click on real quick. That's the terminal EBITDA multiple. Remember, the terminal EBITDA multiple is going to be the biggest factor of our overall valuation. Somewhere between 80 and 90% of the total valuation is based in the terminal value. That's the end of the model out into infinity. Now, 5 times EBITDA is super, super low. It's a 43% discount to the comps. So I just want to go through this real quick. Kroger, the purchaser of Albertsons, if the deal goes through, is at 6 times EBITDA. So it'd be very reasonable to use that as the terminal EBITDA multiple. And then 2 other competitors, which are smaller, have a 9.5 and a 10.9x EBITDA multiple. The mean of the comps is 8.8 times. So I'd be totally justified in using that. The current EBITDA multiple for Albertsons is 5.1x. Now, over the last 11 quarters, Albertsons EBITDA has ranged from 4.1 to 6.8 times. The midpoint is 5.5 times. The average was 5.3 times. So 5 times is on the low end of the comps and on the company itself. So just understand all the multiples for this company from a trading basis, when we're looking at other companies, are trading at a 50 to 80% discount. That's all the way from sales multiples all the way down to earnings multiples. So the company's at a very, very significant discount to its peers. Okay, the moment we've all been waiting for, the DCF valuation. We ran 3 scenarios, a bear, base, and bull case with the current model at base. Remember, we take the future cash flows, we discount them back to today to get TEV or total enterprise value. We strip out net debt, that gives us equity value. Now, the stock is down 13% year to date. It is a low, steady, predictable growth company, but is it worth buying today? Now, Wall Street has Albertsons with a median value of $26 per share. That's a 30% discount. So what does our analysis show? Let's hop in the model. All right, y'all, DCF valuation, we have EBITDA less DNA gives us EBIT. We strip out the cash taxes, get EBITDA or NOPAT. We add back the DNA. We strip out changes in operating working capital. We also strip out the CapEx. We get free cash flow to the firm right here. Then we have the terminal value. Remember, that's based on the 5 times multiple, which is super, super conservative. We get the cash flows to discount. We discount them. We add all of these together, that gives us our total enterprise value. Then we're going to strip out the debt, add the cash, strip out the non-controlling interest, add the associated investments. We get an intrinsic equity value, or our estimate of true value of the company, of almost $16 billion. When we divide that by the current shares outstanding, we get an implied share price or intrinsic value of $27.61. Compared to the recent close of $19.93, that is a 38.5% discount, which is obviously a screaming buy. Remember, on Wall Street, if it's greater than a 20% discount, it is a buy. Sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth and CapEx intensity, as well as weighted average cost of capital, or the discount rate, and the terminal multiple. Now, here's the interesting thing. None of these showed a sell rating. Only 7 or 14% showed a hold rating, and 43 out of 50 or 86% showed a buy rating. Now, running each of the three scenarios, bull, bear, and base, equally weighted, gives us a weighted average value of $31.74. That is a 59% discount. Now, remember earlier I said we would really be justified in using a higher terminal multiple? Well, at a 5.5 times terminal EBITDA multiple, the stock is worth a little over $30, which is a 50% discount. So what is the takeaway? Utilizing conservative assumptions, we show a solid buy rating for the stock with a massive discount of 38.5%. Let's hop in the model. Okay, so as I mentioned, we ran the data tables, 50 different scenarios, the bulk of which green everywhere, which is what we like to see. So the bulk are buy. Now look at this, guys. This is super conservative. The revenue growth, 1.5%. We even have buys in a 0.5% revenue growth scenario. It's crazy. Looking down below, the terminal multiple, this is actually the more reasonable range. So you could see what it would be if we ran it at 5.5 times. Punchline is vast majority, almost 90% of the scenarios are a buy rating. Moving down to the scenario analysis. So with the scenario analysis, we run the bear case, the base case, and the bull case at equal weights of 33.33%. And we actually get pretty much the same conclusion that we received up above with the data tables. We get a value, weighted average value of $31.74. That is going to be a 59% discount, which is an absolute screaming buy. Now, remember, if this deal doesn't go through at $27.25, we're probably going to end up somewhere in this range right here. So the deal not going through might actually be the best scenario for investors. All right, so here's the wrap up. Wall Street has a low for Albertsons of $21, which is a 5% discount, a high of $27.25, basically the buyout price, which is a 37% discount, and a median of $26, which is a 30% discount. The stock has shown a slow decline since the payment of the special dividend in November of 2022. Despite trying to appease regulators with the sale of stores for nearly $2.9 billion, almost 600 stores, it is still not clear if regulators are going to approve the deal. Ironically, if the deal does not go through, that might provide the better investment opportunity. Now, you should always seek the advice of an investment professional. I don't know your financial situation, but I must tell you, Albertsons is currently my largest portfolio holding at a weight of about 12%. This is a rare and unique win-win scenario where the deal not going through might provide the higher upside than the current $27.25 takeout price. As the number 2 grocer in the United States of America, showing steady growth, cost control, and conservative management, Albertsons is a stock that you should check out. If you like this and want to see my most recent tech valuation, check out my Palantir model right here. And if you found this valuable, please share this with someone who you think would enjoy this. And as always, be relentless.